Hi, great to have you here. Would you like to be able to trade like the institutional traders? If yes, then you need to forget intraday trading and focus on EOD strategies, end of day strategies. In this video, I'll go through the pros and cons of end of day trading and show you scaling entry strategy that doesn't require you to be glued to your screen. So, I will provide you with a position size calculator and make sure that you can always scale in your entries and keep your total risk exposure systematic. First of all, please do remember that we don't provide any investment advice and all the material is made available for educational and marketing purposes only. And please remember to subscribe to the channel. That would be a great help. Thank you. Okay, let's define end of day trading first. Now we are talking about analysis that is done in weekly and daily time frames, and these really are the domain of big money funds. These are the guys who move billions and billions of dollars in the markets, and they can't operate in the intraday environment. That's basically because they have too much volume to execute and they would just, the profit margins would be too small for them, so they operate in daily and weekly time frames. And therefore, it's no surprise that most volume is therefore executed in these time frames with the strategies that take advantage of weekly and daily trends and obviously fundamental drivers. So when these two come together, when you have a weekly trend, there's usually a fundamental driver behind it. And if you can identify both, then you are much better prepared to trade the given market. Let's talk about the pros and cons of end of day trading. And first, the positives. It's end of day trading is a less stressful way of trading, basically because you have more time for decision making. You can wait for days for a signal, you can do your analysis, and you're never in a hurry to make a decision. Like in intraday trading, you are forced to make a lot of decisions in, just seconds maybe. But in end of day trading, you can take your time. It's much more relaxed way of trading. Then it provides opportunities to catch long trends. This is obviously not possible when you are trading intraday or taking just price swings. Here we are using weekly trends, daily trends, and so when we get it right, we get a long trend in the market. There's higher quality signals, so the signal to noise ratio is quite high, meaning that the signals that you get, they are more reliable and you don't see all that. If you go, let's take the opposite example here. With noise, I'm meaning, what I mean with noise is just a lot of fluctuations in 1 minute charts, 5 minute charts. And if you are scalping or intraday trading, you are seeing a lot of just wrong signals. And then low opportunity cost. You might be working somewhere else. This is a big benefit. You don't have to sit at your screen all the time. This is a major advantage. So you don't have to give up your day job. And also, the cost of the spread per year is low because you take much less trades. Say if you're an intraday trader, you might make, say for instance, 8 to 10 trades per day. That adds up if you multiply this by 250, which is the number of trading days in a year. So the cost of paying the spread is minimal compared to your average gains. And you take less trades as well, so it works out fine. And let's cover the negatives also. It's not really possible to trade with small account. If your account is really tiny, using end of day strategies is going to be very difficult, if not impossible. Then trade signals, they come less frequently, which means that you can't expect to have daily or weekly income from trading. It takes time for the market to move and to create the profits that you want to have. Then this leads us to a risk that is associated with these positions that you hold for longer. Basically, because you have them for longer, it means that you are holding them through like situations like NFP. These risk events like NFP or inflation data releases can move the market significantly, and your positions are exposed to this. Then there is the weekend risk. Something can happen over the weekend that moves the markets big time, and it could be in your favor, but it could be also against you. So you just have to pay attention to these risks and plan your risk. The position sizing is the word I was looking for. You need to plan your position sizing accordingly. Then, should there be a big risk event or a big global risk like the credit crunch in 2008 or the COVID that spread around the world and caused the markets to move, these events tend to create situations where the correlations go to 1, which means that it's really difficult to diversify well enough during these times. So diversification is a bit of a problem, especially during the times when you would need it most. Then, if you're new to trading, you might ask what markets we could trade. So really the answer is you can trade all of them. You can trade stocks, equity indices, commodities, forex. As long as you can do analysis based on weekly and daily time frames and you see those markets moving, then they are suitable for trading. Let's take a look at end of day trading strategy. It's basically a strategy that looks to take advantage of retracements to support. So very often trading can be frustrating and time consuming because you have to be sitting at the screen for extended periods of time. But this strategy looks to take positions with limit orders. So you don't have to be there for the market to actually to pick up your trade. No, this strategy allows you to work somewhere else. You don't have to be at the screen. So what we are looking for is weekly and daily markets trending higher. We want to see bullish breakout, and then we calculate how much we want to risk. We set limit orders at support level, and I guess the easiest way to show this strategy to you is to use chart examples. So let's take a look at a pound yen chart here. Alright, here I have pound USD chart in 2 time frames. On the left hand side I have a weekly chart, and on the right hand side I have a daily chart. And as you can see, the market has been making lower highs and lower lows, signifying clearly that it's moving to the downside. But after this spike to the downside, the market started making higher lows and higher highs. Now the idea is that if the market has the strength to keep doing this and then push above resistance levels, then we have signs of strength coming into this market, even though it's still inside this big downtrend. Now, the way to trade something like this, and I'm going to show you bar by bar how the market moves, is that you want to see the strength first. And once you have the breakout, and I'm not going to update the weekly chart because that's not so important here. Let's focus on the daily chart. Now that we have established that there is upside momentum building up in the weekly, now we can concentrate on the daily. The daily chart breaks above the resistance, and then what we want to do now is we want to set limit orders at this high or very close to this high. We don't know if the market is going to come down to this level or go a little bit deeper before it moves higher. So we want to set limit orders at different levels to make sure we catch at least some of the following up move. The idea is that it would be too risky to have just one limit order at one place, one price level, and then assume the market's going to go there. That would be risky. So I'm going to show you how to do this. Let's go through the basics of this calculator first. Now, the account size I have chosen here is 15,000. And the market, as we discussed, is pound yen. And the stop size, I'm going to explain to you soon how we get to this number. But you can go to TIOmarkets.com and find a pip value calculator there. Just Google it and you find it easily. And the pip value for pound yen is $8 per pip. So if you take position here, and it's going to be there's going to be a risk of $1,575 per lot. That's way too much. That's 11% of the account. So I'm limiting the maximum risk for this whole total position at 3%, which means that the trade risk is $450 in total. Therefore, the trade sizes are here. The total trade size is going to be 0.3 lots or standard lots, and then we have the trade size per clip. I'm going to use 3 entries, entry 1, 2, and 3, and here we have the variables. I'm thinking that because this is roughly 138, I'm thinking of placing the first order there at 138, and then I'm going to check what the ATR value is. At the moment, ATR value is 131, so that's basically one of the input fields here. I'm inputting 131. And I'm using an ATR multiplier of 1.5. So the stop will be 1.5 times the ATR below this entry price. So entry price minus the ATR times the ATR multiplier. Okay, I have now added 3 entry levels here. These gray dotted lines or dashed lines, they represent potential entry levels. Like I said, the idea is that if we just say that and we're going to expect the market to move to a certain level, because we don't know the future, that's a very risky assumption. The market might actually rally without you. It might come to level that is slightly above the level you assumed it would go to, and then start going higher. We don't want that. We want to increase the probability of getting into the trade, and then hopefully the market will bounce and move in our direction. So the gray lines here are 138, 137 spot 34, 136 spot 69. And you might wonder, why did I choose these levels? Yeah, that's a very good question, because you have to have a method that is somehow systematic, somehow related to the recent volatility. And that's why I have the ATR here. I have a 14-period ATR in this lower window, and currently it's 1.318. In pound yen, that's 131 pips, roughly 132. But I'm going to show you how I'm going to use this ATR value to derive these levels. So let's go and see what the calculator says, the calculator that I have built for you. I'm going to show you the formulas so that you can use the formulas to build the calculator for your own trading if you so want to. Okay, I try to be very brief with this section. The main idea is that you can get to see how to use the calculator and get to see the formula so that you can build your own calculator for your own trading and create trading methodology that is systematic and keeps the risk constant. So the idea is that we want to have several entry levels because we don't know where the market's going to turn. So we can expect that market hits at least a couple of levels and then, or at least one or two levels before it moves higher. If we're lucky, we get the market to pick up all three before it hits and then turn higher before it hits the stop level. The problem with these setups is that if you have only one level, the market might go close to it and then rally higher, or if you have to stop too close, the market picks up your trade or trades and then moves to the stop. So I have created this calculator to overcome all these problems, and if you use it correctly, this really is possible. So let's see what this calculator gives you. It gives you these entry levels. The first level you have to define. I have defined it here with this input field at 138, and then the calculator gives you the other two. That would be these two here. Then it gives you the stop level. It gives you 135.38 based on the ATR value at the time and the ATR multiplier that I have chosen to use here. You might want to have a different ATR multiplier value if you like. It could be 0.5, 0.7, 1, 1.2, 1.5, whatever. You have to decide what's the appropriate multiplier for you. But the general rule is that the higher the multiplier value, the more conservative your strategy is going to be. So the further away the stops are and the lower the probability that the market hits your stop. Then the calculator gives you the total position size here. So that's basically, this is based on the maximum risk per trade and based on the account size. And then it gives you the trade size per scaling in entry. So this is here. Because we have 3 entries, we divide these totals, the trade size, by 3. I think the input fields are quite explanatory, self-explanatory. So the account size is 15,000 and you define the risk per trade here. I'm using a relatively high number for those that are new to trading, but if you're more experienced and if you're sort of P&L data, if your equity curve justifies a high number of high risk taking, then that's okay. You might want to go for lower number if you're, and I suggest that you go for lower number if you are not very experienced and not very successful in your trading yet. And then the trade entry price and the ATR value. You can take that from TIOmarkets MT4 or MT5 platform. And the ATR multiplier value is something that you should keep constant. You choose one based on your historical backtesting, either programmed or manual testing, but choose the one level and stick to it until you later on want to review your trades and then maybe modify the level of risk in your strategy or the level of risk taking. So let's go and see where the formulas are. The first one is here. While I'm talking, you can pause the video and take a screenshot and then move on. I'm basically pausing here a little while so that you can take a screenshot of this. Then the risk per one lot. So that would be your risk based on the stop size here and using one standard lot. And that would result in 10% account risk. We don't want that. We want to, in this example, use the maximum 3% risk. And that means the trade size is 450. So there's the formula for the account risk in percentage, and then the trade risk based on these two cells. Then the trade size in total. This is very simple mathematics. I'm sure you can build a calculator for yourself. And then the trade size per clip is obviously just the total number divided by 3, because we have 3 entries here. Then the trade entry number 2 and the trade entry number 3. The average price is obviously the same as the trade entry number 2, because you have 3 entries. And then the stop level, and one more, the stop size in pips. So now we have calculated 3 entry levels and a stop price. The 2 entry levels and the stop price are based on the recent volatility as we use the ATR here. Let's see how the price moved from this point onwards. And then, yes, here we have the price picking up 1, and then the second entry. So we have 2/3 of the trade size in the market, and the market rallies. This is always the risk that the market goes higher without you. You're not taking all the, or the market is not taking all the levels. It's not picking up all the limit orders, but that's something that you have to live with. Here the market goes a couple of times very close to the third limit order, but it didn't basically hit that. The benefit here is that you have a very systemized approach, and your risk taking is very conservative if you just keep your risk per trade level in that calculator low, or relatively low. Now we have here an opportunity to add this third lot into, or third clip into this position later. Now that we have created some profits, you can find a level where you can basically, using a strategy that you feel comfortable with, you can add one more clip to this and then enjoy the ride. In this occasion, the market rallied quite a bit. This is a daily chart, remember, so you really don't have to worry about this trend or trade as long as the market is making higher lows and higher highs. And obviously a strategy like this allows you to add to the position because the market has created profits for you. And if you don't add too big of a size, then your sort of cost base stays fairly low and you are safe with this kind of trade. I have to obviously say that there'll be losing trades, like with every strategy, all the other strategies, this is the same. There'll be losing trades, so you need to have risk management in place. Now, I hope this was helpful, and I hope that you actually found something useful in this video so that you can have a better understanding on how to create an end of day trading strategy for yourself. You need to obviously add long exit rules into your strategy, and there you might use either moving averages, say the price starts to move below the moving average, or you can say that if the price stops making higher highs and starts breaking the support levels, then you get out of the trade. So now the market has rallied quite a bit, and we can finish this video by checking what was the risk reward ratio for this particular trade. It looks like it was big, but let's make sure we know exactly what it was. and then you can track risk reward ratios for the other trades and calculate the averages and see what's a sort of most common risk reward ratio for your trades, and then you can adjust your risk taking accordingly. So here are the numbers. We basically have 11.43% move to the current level, and then the stop was 1.7% away from the average entry price. And if we calculate the reward to risk ratio, we get 6.72. So that was a decent trade if the trade was closed here. Okay, so now you know how to scale into positions when using end of day charts. Take what you have learned here and start applying it first in demo environment, and once you are confident that you can execute the entries flawlessly, then you can start testing with a live account. And maybe with slightly smaller risk exposure first. Then you can gradually increase the risk when you see success in your trading. I hope you liked the video. Give me a thumbs up, and any emails you can send to support@TIOmarkets.com. I look forward to seeing your questions via emails. Take care and trade safe.